In this video, we're going to look at Ceragon Networks, and this is an Israeli technology company. And what I do in my videos is I run my discounted cash flow model to try to figure out the actual stock price for a company. And I also look at the financial ratios and compare them to similar companies. And I do this on the video with you, so it's like we're doing it together. So let's get started with the model. This company has a market cap of $183.4 million. And that's the value of the company, according to the stock market. To figure out market cap, you could just take the stock price times the shares outstanding. They trade at $2.26, so that's one share of stock, cost a little more than $2. And now we need the free cash flows. And the way you value a company is you have to estimate the future free cash flows, then discount that number back to today's value. And that's exactly what I'm doing in this video. And then we also need the net income, which is the profit and loss. And that's on the income statement. And we pull 4 years of that as well and put it into the model. And then we're going to pull the revenue, which are the sales. You want to take a quick look at the numbers. The revenue doesn't seem to be increasing much. It actually dropped to its lowest level in 2019. And they had a negative net income and negative free cash flow in that year. So those aren't good signs. Let's move forward. Let's figure out the capital structure of the company so we know what discount rate to apply to the future cash flows. They pay $3.8 million of interest on their debt. And we'll go to the balance sheet to see how much debt they have. Current debt is $14.6 million. That's debt due within 12 months. And they don't have any long-term debt. Let's figure out their effective tax rate. We'll go back to the income statement. And it's hard to pull the effective tax rate for certain years because it doesn't really make sense for 2019 because they paid in more in taxes than they earned. Let's take the 2016 number. They had $13 million of income before taxes and $1.7 million they paid in taxes. The tax rate is 13%, so the cost of debt is 22%. That seems really high, but I guess they're a small company. Let's get the cost of equity. We need the beta. That's how much the stock moves relative to the market. And I have a beta of 1.99, so it's pretty volatile, the stock. It moves roughly twice what the market moves. We also need some more information from the balance sheet. We need their current assets. We need this because when we calculate the current ratio later, that's in the numerator, current assets. And that's $215 million. The denominator of the current assets equation is current liabilities, and that's $104 million. We also need the equity, that's assets minus liabilities. And this number is used in the calculation for ROE and the price to book value calculation. Next, we need the EBIT, earnings before interest and taxes. That's called operating income on the income statement. That's $7.3 million. So let's look at a capital structure. The cost of debt is 22%, and they have 8% of debt. The cost of equity is 17%, and they have 92% equity. So the WACC is a blend of the cost of debt and cost of equity. That comes out to 18%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. And we figured out these estimations based off of the prior financial information. We discounted those numbers back to today using the weighted average cost of capital. And we come up with a value for the company of $58 million. We divide that by 81 million shares, and we get a calculated stock price of 71 cents. So they're trading at $2.26. They're trading at a 218% premium. So it's a sell according to the model. Let's see what Simply Wall Street. They're a little lower. They're at 43 cents a share. It's a lot harder to value these small companies, but until they grow and start having more consistent positive data, that's when we'll be able to get a better value. Let's see where the stock has been trading. It looks like it was trading over $4 at one point, and then it's come down to $2.17. So it's kind of been all over the place. Let's look at the financial ratios. They have a negative PE because they have negative earnings. Earnings are your net income. They have a good price to sales ratio of 0.6. That's price of stock over sales per share. I like to see under 2.5 for this ratio. They also have a good price to book. That's price of stock over book value per share. I like to see under 3.5 for this ratio. They're doing okay in current ratio. They can cover their current liabilities. They have a negative ROE because they have negative earnings. They can cover their interest payment 1.9 times, so not much of a cushion there. And the debt of 8%. And the best way to look at ratios is to compare them to similar companies. So I've done videos on Cisco and HP, and these are much bigger companies than Ceragon. And in terms of PE, HP is the best, and price to sales, HP is also the best, and in price to book, they're the best. So Ceragon is worse than the average in price to earnings, but they're better than the average in price to sales and price to book. They're also better than the average in current ratio. They're worse than the average in ROE. They're better than the average in debt because they only have 8%, and the average of the three companies is 32%. And they're much smaller than the other companies, especially Cisco. So let me know what you think of these smaller companies. Do you like me making these types of videos? Thanks for watching.